Thank you for the introduction. Thank you for giving me the opportunity to present this work. If you look at the title, I rearranged the three different items in a different order. I put first what I think is most important, exhaustible resources, financial systems second, and income inequality third. Those are my three research agendas, and not all of them are done using the IMF's model, although some of them are. Some of them I just developed as separate pieces of research. Here's the usual disclaimer. I'm not standing here as somebody who's presenting official IMF positions on anything. This is a collection of research results. So I designed the theoretical foundations of the IMF's global DSG model. It's GIMF, Global Integrated Monetary and Fiscal Model. The IMF uses this model a lot for policy and scenario analyses to think about what certain policies or certain shocks would do to the world economy, and how to respond to such shocks, etc., etc. And all the work, almost all the work that I'm going to present today is based on DSG models, and over the last 2 days I heard the occasional bar directed at DSG models. I think that criticism is by and large misdirected, because DSG is just a technology. It matters what you do with it. The technology itself is great. You can show things with that technology that go completely against what neoclassical economics would suggest. And while talking the language of neoclassical economists, which is an incredible advantage when you want to communicate with people who matter. And so I really think DSG is for me, is something that I'm always going to use. So my view is that the three most important challenges for contemporary policy are all being modeled inadequately by the current generation of DSG models, but that can be remedied, and I will show you some efforts at remedying that. The three most important challenges are in decreasing order of importance, meaning starting with the most important one, exhaustible resources, especially oil. This is my personal view. We can argue about that. What I note when reading the literature is the fact that oil is exhaustible and could peak by 2020 or even before that is not even taken seriously, and the evidence is it's a very seriously done engineering and geology type studies like the UK ERC 2009. And we ourselves have also done some research on this question with state-of-the-art econometric methodology. Also, the contribution of oil to economic activity may be underestimated by focusing on its low cost share. There are some simulations in the IMF World Economic Outlook in 2011, and a working paper that came out earlier this week goes deeper than that and expands on these issues. And finally, the substitutability between oil and other factors might be overestimated. And if you think about oil becoming scarce, the substitutability with other things is of course absolutely critical as an escape valve. Monetary financial systems design, existing models are based on banks intermediating funds between savers and investors. There are now DSG models of banks. They started in 2007, 2008, but they're all based on the highly misleading notion that the main function of banks is intermediating funds between savers and investors. I argue that this is secondary, that it is coincidental, and I could build you a model of the economy completely without any intermediation, and I would still need banks, namely in order to create the money supply. Of course, there are a lot of people in this audience who will be familiar with that notion. I think the innovation here is that we build a DSG model that does exactly that, and that is new. The new generation of models that we're now building, and the IMF, this is a research priority, which it should be given the urgency of problems in that sector, will focus on the ability of banks to create and destroy money. Without recognizing this, the contribution of banks to business cycles must be grossly underestimated. The fact that our monetary system must generate massive debt levels, both public and private, cannot really be understood. And the possibilities for policy to deal with these two problems are also not properly understood. Inequality, started working on that in 2010 with Romano and Sierra. I have another paper that came out earlier this year on the open economy aspects. Greater inequality is partly a consequence of financial liberalization and what's been happening in the financial sector, but also financial liberalization in turn may be a consequence of greater inequality. So it's a two-way street between the two. So the topic 2 and topic 3 are definitely related. The insistence on representative agent models or even on impatient agent models has obscured the importance of inequality. And in our joint paper, Kumhof and Sierra 2010, we show that greater income inequality can be a fundamental cause of financial crises. And in a more recent paper, we show that it can also cause current account imbalances, meaning it can cause domestic debt and foreign debt. So now I'm going to go in a little more detail into each of these 3 topics. Exhaustible resources, we have a working paper out. It's called The Future of Oil, Geology versus Technology. Conventional models, empirical models, have great difficulty predicting future oil prices, and they typically find it hard to beat a random walk for oil prices, which means the best predictor of tomorrow's price is today's price. And official institutions, furthermore, like the EIA, have had to dramatically revise their forecast, not of the oil price, but of the oil output downwards over the last decade. It's documented in this paper. Every single year since 2001, they've had to revise it downwards. The alternative to these approaches, conventional approaches, is to actually take geological limits to oil supply seriously, and I do. Our empirical model, therefore, combines both approaches. Namely, it has a feature inside whereby geological limits are key for an upward trend in oil prices, but demand shocks through higher prices can also increase production, meaning that there is a price sensitivity of oil supply, but there is also a pure geological component of oil supply, and they work together to determine prices and quantities. This is not a DSG model, by the way. This is the only non-DSG model that I'm going to talk about. This is basically empirical. The performance of this model, it delivers a very nice decomposition of history. What were the shocks that caused the observed history of oil prices and quantities? And the forecasting performance is far better than competing models. What do our forecasts say? The EIA, this is the US Energy Information Administration, forecasts 0.8% annual supply growth. That's the most recent one that I saw, roughly. And we find that this may be feasible, but only if real oil prices nearly double over the next decade. Not nominal oil prices, real oil prices. That's a big number. It takes us into uncharted territory, because this would not just be a temporary event, but permanent. They would stay there, and they would keep rising upwards. World growth could be significantly lower, but not that much, and I'll discuss that. So here are the so-called root mean squared errors. These are the errors I make in forecasting oil prices and oil production using our model. And for oil prices, the alternative is a random walk. And for oil production, the alternative is the EIA's own forecast over the last few years or decades. And we find that our model far outperforms a random walk for the oil price, and that it does far better than the EIA at anything but a 1-year short-term horizon. Okay. Here is an interpretation of the oil price history. Basically, the blue line in the top left represents actual oil prices. Okay, this may not be, I don't remember whether this is not in current price, this is normalized at some year's price. I forgot. Because this is the real oil price. So what we see, basically, we say in 2002, we say, we have estimated the history of this model up to 2002, now let's forecast this model up until 2011, and what does it deliver relative to sorry, this is wrong. Sorry. How does it decompose the actual history that we observed between 2002 and 2011? And so what we see here, the blue line on the top left is the actual oil price. The red line is what the model would predict starting in 2002, assuming no further shocks to oil supply, oil demand, or aggregate demand. So this model delivers a prediction of an increase in the oil price that is fairly consistent with the average increase in the oil price that happened over that decade, and it's because of a Hubbard linearization feature. This is from the peak oil literature. Kenneth DeFay came up with the feature that built on the work of M. King Hubbard, who predicted peaks in supply in the US correctly in 1970. And we basically adapt that to the world oil market and then make the model predict using that feature and find that that alone could explain the upward trend in oil prices over recent decades. But then oil demand, the top right shows us the contribution to what was observed coming from oil demand. And there were big deviations. Oil prices were even higher than what was explained by geology. We interpret that as the China, India growth, etc. Oil supply, in roughly 2005, world oil supply switched from an historical growth rate of 1.8% per annum to one of roughly 0% late 2005. And at that point, oil supply shocks made a contribution to driving the oil price up further. And then output gap shocks explain the collapse of the oil price in 2008, 2009. So to us, this is a very sensible decomposition of history. And now, what we're doing is now let's see where we go from, where we are likely to go from here. So this is a forecast starting in 2011, using all the data and what we've estimated the model as up to until 2011. What do we think oil prices are going to do going forward? And basically the point forecast is in the middle, is the blue line, and it says it would roughly double between 2011 and 2020. And it would keep rising after that. And the other thing to notice, however, are the very large error bands. This is a statistical model, right? It's estimated with non-linear Bayesian methods, state-of-the-art stuff. And we are able to have error bands around that estimate. And the error bands are very wide. And what that means is there's a lot of stuff that we don't know about the oil market, like elasticities of supply and demand, ultimately recoverable reserves, etc. But this should be, if you take it seriously, a very scary chart. And then what we do is we also do some simulations of oil shocks in our global model. This is the sort of sixth region of the world economy model that I built at the IMF, where we put an oil sector into it with the exhaustible resource feature, in the sense that the oil supply is mostly an endowment. Right? And very low price elasticities of supply and demand, and there's a literature that supports those very low price elasticities. And we find that the oil price effect in the benchmark simulation is very similar to our empirical paper, which is good, but that aggravating factors like peak oil, if actual output of oil should at some point in the future start to decline in absolute terms, or if the substitutability becomes lower in the future than it is today, or if oil makes an output contribution that goes beyond its cost share, then the output effects can become very much larger, but they're still not enormous. What is enormous is the oil price effect. So here we see the simulations. We group the countries into oil exporters, US and Euro area and rest of the world. And the baseline scenario is the blue line. As I said, that's consistent with the empirical work. The red one is technology externality. This is saying a lot of what we have been counting in the decompositions as technology shocks has in fact only been possible because we've had oil to run these technologies with. And if that oil wasn't there, the value of this technology would go up in smoke. And this, therefore, an oil supply shock could have an aspect of a negative technology shock. And that makes the output effects quite a bit larger. If the larger shock is there, that also makes it larger. And finally, if we combine these effects, you can get a large output effect, but the range of the output effect is between 0.25% per annum growth loss and 2% per annum growth loss. The 2% is very dramatic in the worst possible combination of cases. 0.25%, you know, it's not insignificant, but not that much. What is dramatic is what the implied oil prices are, and this is on the horizontal axis we have timed how is whenever this shock happens. It might not be now, it might be 10 years from now, or it might be yesterday, we don't know yet, right? And so what the oil price predictions are is about 100% increase after 10 years and 200% after 20 years, as in our empirical model. But in the worst case scenario, you can get oil price increases of over 1,000%. And this is just what the model delivers as is. And it doesn't make any sense. I don't think the economy would survive oil prices of this magnitude. Something else would have to give. There have to be non-linearities. And I interpret this as a challenge, as a research agenda, to think about what in the model I need to change in order to capture these potential non-linearities. Now, let's move on to financial systems. Our new generation of model, the primary function of banks is not intermediation of savings, but creation and destruction of money. The deposit multiplier is nonsense. It gets a transmission mechanism backwards. Banks can create huge booms and busts that would be impossible if they were just intermediating savings. You can show that in the DSG model. Banks create huge debts that exist for the main, not the only, but the main purpose of creating enough money to service transactions needs. This is unnecessary if money was publicly supplied. 100% reserve banking dramatically ameliorates these problems. So 100% reserve banking, the Chicago plan, basically, I don't need to say too much about this here. We're separating the money and credit functions of the banking system. And the way I do that in the model is I build a theoretical model of the banking system and the entire US economy as it is today, the DSG model. It's something, the building blocks of it look familiar to the conventional monetary economists out there, except that I have a proper modeling of banks and they do not, or they don't even have that. And then I build an alternative model that is the world under the Chicago plan, and then I say, okay, what would the transition look like if the Chicago plan world inherits the state variables of the current world? And we find, we fully confirm the advantages stressed by Fisher: much better control of bank lending-driven business cycles, complete elimination of bank runs, dramatic reduction of the net public debt, dramatic reduction of private debts. And then in addition to that, because we have used the DSG model, we find some additional stuff that isn't so obvious if you don't try to model this. First, large output gains that approach 10%, and also elimination of liquidity trap problems, which at the current juncture of policymaking is actually of considerable advantage, interest. And here is the balance sheet situation under the Chicago plan. All numbers are in percent of GDP. On the left-hand side here is the world as we currently envisage it. And these numbers are based on a very careful reading of the data. We spent months doing that, analyzing the flow of funds, etc. And so the balance sheet is 200% of GDP. This includes the shadow banking system. 80% are investment loans for productive investment. 20% are government bonds, because most government bonds are not held by banks. And 100% are mortgages and various short-term loans, and all that's financed by deposit and by some bank equity. And this is fully consistent, the model of banks is fully consistent with the Basel rules of capitalization. The Chicago plan basically then says we have to cover the deposits with, we have to cover these deposits, we have to back these deposits not with these private loans, but with reserves of public money. And the way we get these reserves of public money is by borrowing them from the public sector, from the government. And so there is a corresponding liability of the banking system, which is the loan that is necessary in order to get these reserves. And then we're recomposing this balance sheet to actually show the reserves next to deposits, but something, and then there's a big thick line which says that is completely separate from the credit function of the financial system. As far as the credit function is concerned, what I'm assuming here is the following. I'm assuming that this treasury credit that the government has is basically makes net government debt minus 100% of GDP. It's a very large number, and the government can at that point say, what do I do with this money? And I'm assuming they're distributing a citizen's dividend to everybody out there, equal per capita, what have you. And this citizen's dividend needs to be used, this follows some work of Steve Keen, needs to be used in order to repay outstanding private debts. Okay? And so then what, except for investment credit. And this is just one way of doing it. This is illustrated. Right? What happens, therefore, is that all these private loans here, mortgages and short-term loans disappear, they get cancelled, and on a net basis. You know, because agents are in fact heterogeneous, so on a gross basis there will still be some balances outstanding, but there will be a hell of a lot smaller than they would be under the current system. So basically what we're then left with is a very much smaller credit system that focuses, as in the old German way of doing banking, entirely on providing credit for productive investment purposes and for nothing else. There is private credit remaining in this system. It's just not shown in this balance sheet. It depends on heterogeneity between borrowers, between some people who have high debts and some people who have relatively low debts. It's taken care of in the description, but not in the actual balance sheet that I'm showing you. Let me skip over this. So what happens in this world is because the debt levels throughout the economy decline, real interest rates there, these are 60 quarters on the horizontal axis. Once I do the transition from the Chicago plan at this point, from the current world to the Chicago plan at this point, what happens over the next 60 quarters? Real interest rates decline, depending which one you look at, by between 2 and 3 percentage points. Inflation drops by 3 percentage points. Inflation goes to 0, so nominal interest rates drop by over 5 percentage points. Labor tax rates decline by 5 percentage points and capital tax rate by a similar amount. Both the lower interest rates and the lower tax rates lead to an investment boom, and output increases by 10% in the very long run. Now, the 10% is something we can quibble with. It depends very much on how you calibrate the model, but the number is going to be substantial. And then, the fiscal variables, basically the deficit to GDP ratio is going to go down a lot. This is partly because of very much lower inflation that automatically reduces that. The debt to GDP goes down, debt service to GDP goes down. The main item is at the bottom. The staying garage revenue to GDP, which started off at 0 approximately, it goes to 3.6% of GDP. And this is not an inflation tax because there is no inflation in the economy. This is basically growing the money supply at a 2% growth rate because the real economy is assumed to grow 2% real. And basically just making the money supply grow to satisfy the needs of the real economy gives you a 3.6% per annum, which I assume here is spent on lowering taxes, which gives an additional boost to output. Okay? And here is how the Chicago plan could be dealing with business cycle shocks. This is the so-called news shocks that are very popular in the current literature. And so basically, for 3 years, banks decide that they're now optimistic about their borrower risk and they start lending like crazy. And especially under the current system, they can do that very easily and because they can create their own funding in the act of lending. And so big risks build up on balance sheets for these 3 years. And then I'm assuming after 3 years, it turns out that this was all just a misperception by banks, and they suddenly become very pessimistic about the economy, and everything tanks, and GDP tanks by about 6% here, which is sort of the order of the magnitude of the Great Recession. And that is the black line that I have there. The black line is the current system. Let's concentrate on the red line. That's the alternative, the red dotted one. That's the Chicago plan, when the monetary authority controls the rate at which it lends to investment credit providing banks, and also there's some quantitative lending guidance a la Richard Bernard. And what you see is that in that situation, the banks never lend as much in the first place. They build up a nice, the Basel ratio there, they build up a nice equity cushion because policy forces them to when they want to lend too recklessly. And so when the crisis actually arrives, banks have far smaller exposures and a bigger equity cushion to deal with this. So that means that real interest rates don't rise by nearly as much when the crash happens, and consequently GDP, the amplitude of fluctuation of GDP is roughly half of what it is under the current monetary system. Final topic, inequality. That should work. Inequality has increased dramatically in many developed economies. domestic debt to income ratios have increased simultaneously in the US and the UK, but only for the bottom 95%. So basically what we show in our work on this topic, and this is again a DSG model, but it has two agents and not a representative agent. It basically has class, right? Two economic classes. What happens then is that basically there's lending from the top 5% to the bottom 95% due to inequality, because the top 5% take home more of the economic pie, the bottom 95% try to cope with that by borrowing, and the top 5% are willing to lend it to them because they have wealth in the utility function. This creates financial fragility, not immediately, but after decades, which is kind of what we observed. You know, the fragility has been building up since the early 80s. And we also see that countries with the highest increase in inequality have also experienced the worst deterioration in current accounts. There are exceptions, like Germany, and we're working on that right now. And with Till, we have a project on that, and Till also has an independent project on that. That's certainly true, but there is nevertheless an important empirical regularity. These are US domestic debt to income ratios by income groups starting in 1983. The red one is the top 5%, and it's basically flat or even declined a little bit over this period. The other one is the bottom 95%. It basically more than doubled over these 3 decades until just prior to the Great Recession. And the reason for that, as we claim, is that their real incomes were stagnating. So that was the domestic thing. This was the closed economy. Here is a chart for the open economy. And what we have here is all the countries that we could find data for between 1980 and 2000, roughly. So Germany, the action only started after 2000. And basically what we have here is the change in the top 5% income share on the horizontal axis and the change in the current account to GDP ratio on the vertical axis. And you see a nice negative relationship. And this basically means the worse your income inequality gets, the more your current account over that period, this is all in terms of changes, goes into deficit. Okay? Now, and the other thing that we notice is that most countries lie to the right of zero, so income inequality has deteriorated almost everywhere. Right? And so that's the more recent paper that we've written about that, tries to explain this open economy aspect. And it goes beyond just a simple scatter plot. We do empirical work, and we show that this negative relationship survives after controlling for various other variables. So what you need for that is not to have a representative agent model, of course. Right? So you need a two-agent model, and we model that as the rich, the investors, and everybody else, the workers. And there's a bargaining game over wages, and there's wealth in investors' utility function. When investors gain income, at the expense of workers, there will be an increase in credit demand because workers will try to borrow to raise their living standards. But the more important channel is credit supply. Investors want to lend to acquire more financial wealth. They have wealth in the utility function, because you know when you become richer and you're already so rich, you can only buy so many Armani suits, and you can construct only so many factories, especially when the output of that factory needs to be sold into a country where the income of your customers is stagnating, right? And so the other thing that you're going to do with your money is precisely to lend it back to those whose income is stagnating so that they can keep buying the products. As a result, debt and crisis probability go up, and this is a baseline scenario. I think I have maybe 3-4 more slides. I think this should be okay, right? This is a baseline scenario. This time on the horizontal axis I have years, because this is a generational phenomenon. We're showing 50 years. And so top left there, the bargaining power of workers declines. As a consequence, their real wage declines. In year 30, we have a crisis. That's where the blip in year 30 comes from. But in the beginning, the real wage drops and the return to capital increases, and so that's basically the redistributive shock in bargaining power. Looking at the second line, the investors, what they do, they use the extra money to consume more, to do more physical investment, but mostly to lend more of that money that they gained back to the people who lost the income. And so the loans go up one heck of a lot. And so then in the last row here, workers reduce their consumption, but not by as much as their income. The rest is borrowing. Workers' debt to income ratio rises from about 64% to approximately 130%. It's a little less than in the data. More recent work, we've updated this. We can exactly match the data. It's not a problem. Okay. So, and when workers' debt to income ratio increases, this increases the probability of crises. That's very easy to show in a theoretical model, and we now actually have an endogenous default model where this happens exactly. It's awful to solve that kind of model. It's computationally really, really difficult, but we are there. So, and then in the paper we're saying, what would be alternatives to this? You know, you could talk about a debt write-off or something, but if the debt write-off doesn't solve the underlying inequality problem, as soon as people's debts have been partly forgiven, they start borrowing again, because they still have this inadequate income, and investors still want to lend to them. Taking into account the probability of default, which is always just 2, 3, 4, 5%. There is a premium for that, but it's not that high. So here we claim, let's look at another scenario where we just restore workers' bargaining power. And there's discussion in the paper of how that could happen. It's not that easy, obviously, it's a big question. But let's assume that workers' bargaining power in year 30 is restored. And we're also saying, and for good reasons, as will become obvious, that that is enough to forestall a crisis. So there will not be a crisis in year 30. So bargaining power returns to its original level in period 30. At that point, the real wage increase gives workers the means to service their debts. So what happens is that leverage, the workers' debt to income ratio at that point declines immediately because of an increase in their income. It's debt to income, income goes up. But after that, also, debt to income goes on a downward path because now the workers suddenly have the means to service their payment, so to service their debt obligations. And so we don't even need a big default to get out of this. We can get out of this in an orderly fashion just by changing bargaining power. And that's what we're advocating in the paper. So, summary. In my view, the three most important challenges, in my view, these three are the most important challenges for contemporary policy. You may disagree. They're all being modeled inadequately by the current generation of DSGE models, but that's not the fault of the DSGE technology. That is the fault of what people do with their DSGE technology. Okay, and so what we have done, we have used DSGE technology to show that you can actually, within that framework, solve this. Oil, in my view, is the most important of these problems because it's a hard constraint. That's not something, if I'm right with my concerns about geology, this is a hard constraint. You can do as much policy as you want, eventually you're going to hit that hard constraint. You can ameliorate it, but policy cannot completely remove this constraint. Monetary financial systems design, I have second on the list. It is almost as important, it's huge, but it can, in principle, be fixed by policy, even though that is also extremely hard, as we all know. Inequality is also very important, but there are many ways of fixing that. Not just with monetary financial reform itself to fix that. Tax changes, like more progressive income taxes, which are not necessarily distortionary, like what recent research has shown, and taxes on economic rents, which is completely neglected in the current debate among mainstream economists, that you could tax rents in order to finance a lowering of labor income taxation and thereby to increase the income of the bottom 95% in relative terms. Or you could directly strengthen the bargaining power of workers. Again, very difficult. People will scream international competition and all of that is true. You cannot do these things very easily, but doing nothing is not necessarily the better alternative, because what we show in our work is if you do nothing, then you're just going to have a succession of financial crises, because people are forever in high debt and can never work themselves out of it, and the only escape valve for this economy is the occasional default. Thank you very much.